The smart money always moves first. While newspapers trumpet prosperity and politicians promise endless growth, a select few are already heading for the exits. They see the cracks before they become canyons. They smell the smoke before the fire consumes everything. And in the final hours before disaster strikes, they act with precision while everyone else sleeps through the alarm. October 28th and 29th, 1929 were no different. As millions of Americans dreamed of riches that would never come, the real players were making moves that would define the next decade. The question isn't whether the crash was coming. The question is what the insiders knew, when they knew it, and what they did about it. While ordinary investors were still buying the dream, the Roaring Twenties had intoxicated America like no decade before. Stock prices doubled, then tripled. Radio companies, automobile manufacturers, and consumer goods firms saw their shares rocket skyward month after month. Ordinary Americans who had never owned stocks before were borrowing money to buy them. Taxi drivers gave stock tips. Shoeshine boys discussed market trends. Everyone believed the party would last forever. But beneath the euphoria, a handful of seasoned investors were watching different signals entirely. Joseph Kennedy, patriarch of what would become America's most famous political dynasty, was already positioning himself for catastrophe. The story goes that he decided to exit the market after his shoeshine boy started giving him stock advice. But the reality was more calculated. Kennedy understood leverage better than most. He knew that when everyone borrows to buy stocks, the system becomes a house of cards. One strong wind and everything collapses. By late October, Kennedy was not just out of the market. He was betting against it. Bernard Baruch, the legendary financier who had advised presidents, had also been reducing his positions throughout the summer of 1929. Baruch had lived through the panic of 1907. He knew the warning signs. When speculation reaches fever pitch, when borrowed money floods the market, when everyone believes prices can only go up, that is precisely when they prepare to fall. Baruch later wrote that he could sense the danger in the very air of Wall Street. By October, he had converted most of his portfolio to cash and government bonds. He was ready for the storm. But it was not just individual investors. The Federal Reserve, America's central bank, had been tightening credit throughout 1929. Interest rates climbed from 5% to 6%. The message was clear. Easy money was ending. When central banks stop feeding the bubble begins to die. Yet most investors ignored these signals. They were too drunk on profits to notice the bartender cutting them off. European money had also begun fleeing American markets. Foreign investors, particularly the British, had watched American stock prices climb to levels that defied logic. British banks quietly liquidated their American holdings throughout September and October. When the crash came, their money was already safely across the Atlantic. The signs were everywhere for those who knew how to read them. Margin calls had been increasing for weeks. As early as mid-October, margin calls were flooding brokerage houses. Smart money saw this as a red flag. Trading volumes had also been climbing to unprecedented levels. On the surface, this looked like enthusiasm. In reality, it was desperation. Heavy volume often signals that large players are distributing their holdings to smaller investors. The professionals sell to the amateurs, who still believe the story. Even the companies themselves were giving signals. Corporate insiders had been selling their own stock in record quantities. When the people who run companies start dumping shares, it suggests they know something the public does not. Jesse Livermore, perhaps the greatest speculator of his era, had been positioning for disaster since early 1929. Livermore understood crowd psychology better than almost anyone. As 1929 progressed, he built enormous short positions, preparing to profit from the crash. The bond market had been sending warning signals for months. In late 1929, Bonds began to strengthen even as stocks climbed higher. This divergence showed that sophisticated investors were quietly moving money from speculation to safety. International currency movements also hinted at coming chaos. Central banks in Europe began accumulating gold instead of dollars. It was a quiet vote of no confidence in American financial stability. Perhaps most tellingly, the very structure of the market had become dangerously unstable. By 1929, nearly 40% of stock purchases were made with borrowed money. Investment trusts were borrowing money to buy stocks in other investment trusts that were also borrowing money. It was leverage upon leverage upon leverage. The professionals had seen this pattern before. They knew that financial gravity always reasserts itself. What goes up without underlying value must come down. The only question was timing. And by late October 1929, the timing was becoming clear. While newspaper headlines still proclaimed the dawn of a new era of permanent prosperity, the real players were making very different calculations. They had studied history, and history was about to repeat itself with devastating precision. On the morning of October 28th, Black Monday, trading opened with heavy selling pressure. The smart money recognized this as the beginning of the avalanche they had been anticipating. While amateur investors held on, hoping for a recovery, the professionals were accelerating their exit. The telephone lines between Wall Street and the great estates of Long Island were burning with activity. Wealthy families were liquidating positions they had held for years. These were generational wealth preservation moves. The old money families understood something newer investors had forgotten. Markets can take away decades of gains in a matter of days. As October 28th gave way to the 29th, private secretaries worked through the night, coordinating with brokers. These were not panic decisions. These were carefully orchestrated moves, planned for months. The private dining rooms of Manhattan's most exclusive clubs were filled with hushed conversations. These were emergency strategy sessions, where America's financial elite coordinated their responses. They shared intelligence about which banks were most exposed, which companies were carrying too much debt. This was insider trading in its purest form, though perfectly legal under the regulations of 1929. As dawn broke on October 29th, Black Tuesday, the stage was set for one of the most devastating financial collapses in history. The opening bell rang to immediate, overwhelming selling pressure. But for those who had been preparing, the crash was not a disaster. It was a harvest. They had spent months planting the seeds of their strategy, and now they were ready to reap the profits that come from being on the right side of history when everything falls apart. The crash of 1929 was not a surprise to those who mattered. It was a carefully orchestrated transfer of wealth from the many who trusted to the few who prepared. While millions of Americans watched their life savings evaporate, the smart money was counting profits that would compound for generations. The lesson is brutal, but timeless. Markets reward preparation, not hope. They favor those who read signals over those who believe stories. And they always punish the crowd while enriching those bold enough to stand against it. History doesn't repeat, but if you ignore its patterns, it will crush you all the same. If you are ready to continue decoding the financial myths that shape our world, subscribe to Economythics and click the notification bell.